Like the Bollinger Bands %B indicator, the Bollinger Bands Width indicator presents select information from the regular Bollinger Bands indicator in a simplified way for easier reading. Specifically, the Bollinger Bands Width indicator can help make it easier to see contractions and expansions of volatility. It indicates the width the upper and the lower Bollinger Bands are apart from each other. Higher volatility is displayed with the indicator's line rising, and lower volatility is shown with a decline to lower values. This can be a clear way of presenting drastic changes in volatility compared to the regular Bollinger Bands indicator. If you're interested, you can research further details on the indicator's calculations. As usual, the main focus here will be on explaining how to use the indicator with real chart examples. We'll see Bollinger Bands Width applied under various conditions to observe its pros and cons. A wide range of real chart examples will be covered from various time ranges, meaning information presented in this tutorial can be of use to you, regardless of when you watch this or which particular charts you choose to apply the Bollinger Bands Width indicator on. As this uptrend develops, Bollinger Bands Width generally increases. Then once values begin to plummet, there is an indication of a drastic slowdown to the uptrend. Once values begin to flatten out at these much lower ranges, a distinctly new phase has begun on the chart that centers around this horizontal range, where there's naturally lower activity for the time being. In the short term, there's recently been another minor downswing taking price into the lower half of this range. While at the same time, there's been a minor but noticeable increase of the Bollinger Bands Width indicator. Now with that strong close under the lower boundary of this range accompanied by the return of higher volatility, as shown by the steep increase of this indicator's values. A decisive bearish reversal finally begins, but the strength behind that initial break isn't sustained for long as there's a rapid shift back to lower volatility. At the same time, an overall decrease in selling pressure leads to a neutral to slightly bullish stance developing. This simple line representing a decline in volatility can sometimes be preferred when other information from the regular Bollinger Bands is not necessary. And you may have already noticed this, but the Bollinger Bands Width and the regular Bollinger Bands indicator are not indicators of market direction, such as in this case where price goes down while the indicator's line goes up. Volatility expansion or increase can be likened to potential strength for movement, which can be going down up or simply horizontally fluctuating, such as right here immediately after the gap down. When there's a decrease, also called a contraction of volatility, stronger movement at this current time is low, and it's likely a pause before the build-up to more major movement once volatility inevitably increases once again. Choosing to use one indicator over the other, or using both at the same time is a matter of personal preference concerning how changes in volatility get presented on the chart, and whether or not you want the information from the median along with the upper and the lower band of the regular Bollinger Bands indicator. See here a regular gap up just with the regular Bollinger Bands indicator alone. Now add the Bollinger Bands Width indicator. You can observe for yourself which one you prefer to indicate changes in volatility. From November to early December is a good example of volatility still being able to rise after a gap up. Now the opposite with a gap down, where it may actually be slightly easier to see the contraction of volatility, first with the Bollinger Bands Width indicator, since its appearance doesn't get distorted as much compared to price and the Bollinger Band indicator, which have to scale on the chart. It's quite common to see a pause following a gap as the market enters into a phase of deliberation after such a significant move in a relatively short time. This can lead to a shallow decline in volatility that's a bit easier to see with the Bollinger Bands Width indicator. When this happens, price is maintaining a neutral to slightly bearish stance, thereby giving bearish context when volatility returns higher. We get an indication this bearish strength is weakening as the Bollinger Bands Width indicator significantly drops, along with a noticeable contraction of the regular Bollinger Bands indicator. Price has recently been neutral to slightly bullish, yet regular surges of selling persist. It's quite a similar situation to the period immediately after the gap down. A bearish continuation seems more likely, seeing as how volatility significantly increases just as price is dropping over the past few days. Like normal, the strength of a breakout quickly begins to fade following this initial surge, as more clearly shown by the Bollinger Bands Width indicator beginning to plateau before showing that familiar sharp drop into these lower values, where unsurprisingly they were also around this area during the last major volatility contraction. That would of course not mean price needs to be at the exact same price range it was trading at the last time Bollinger Bands Width values were this low. Decreased volatility simply means price is currently at a phase of weaker directional movement in a relatively narrower horizontal range. It's a repeat of the same kind of situation where price is neutral to even slightly bullish. Yet strong selling volume is still present. Thus, it's no surprise when there's another bearish continuation marked by a sharp increase in volatility, which in this case means strong to moderate strength behind the continued drop. There is another contraction which can more easily be seen with the Bollinger Bands Width indicator plateauing and curving down sharply. Not too long after this is quite noticeable with the regular Bollinger Bands indicator, which puts us back to square one again in this series of bearish continuation situations, which expectedly repeats again with similar features. Here's a similar scenario but at a much more rapid pace. After the usual decline in volatility, the Bollinger Bands Width indicator doesn't flatten out at lower values nearing the end of May, but instead goes straight to a sharp reversal back to previous high values of volatility to indicate the quick return of strength for another bearish continuation. Rather than looking at another sustained long-term downtrend like the last example, let's take a look at an opposing scenario. We begin with the normal slowdown to the drop as the Bollinger Bands Width indicator reaches lower levels and flattens prior to a noticeable spike back up. What's different here is the strong bullish presence that will eventually slow down as the indicator also begins to plateau and reverse back down to lower values. As expected, price begins to move in a narrower range, and although it flattens somewhat, there's still a noticeable shallow incline. Which means if there's another series of green candles strongly closing higher, it could be said there's strength behind a bullish continuation once there's another sharp reversal back up for the Bollinger Bands Width indicator. Naturally, this overwhelming bullish context is only maintained for a brief period before the market returns back to another period of lower volatility with less directional movement in this repeating cycle. For more on indicators as well as Fibonacci methods, follow Ascencore. Thanks for watching and have a nice day.